Today, we're going to break down something that confuses a lot of people. So, the difference and the relationships between the Fed Reserve interest rates, the mortgage rates, and the US Treasury rates. Three different things and not necessarily correlated at all, really. So, we'll talk about what each one of them is, what affects each one of them, and how they affect each other. And hopefully by the end of the video, you'll be able to explain these differences to other people. And, even if you're brand new to finance. Hey everyone, welcome back to the channel. Today we're going to break down something that confuses a lot of people. So the difference and the relationships between the Fed Reserve interest rates, the mortgage rates, and the US Treasury rates. Three different things and not necessarily correlated at all, really. So we'll talk about what each one of them is, what affects each one of them, and how they affect each other. And hopefully by the end of the video, you'll be able to explain these differences to other people. And, even if you're brand new to finance. All right, so here goes. So first one is the Federal Reserve rate, or the Fed. And, this one gets a lot of press. You hear about it when the Fed meets, and there's a lot of anticipation. What's the Fed going to do? So this is the rate that banks charge each other for overnight loans. So it's a very short-term rate. And it's what the Fed uses to control the supply of money in the economy. Like if they want the economy to slow down, then they raise rates. When they want to encourage growth or people to spend more money, they lower the rates. So think of it like this. So the Fed funds rate is like the price of borrowing money at the core of the financial system. It doesn't directly set the mortgage or the treasury rates, but it definitely influences them. All right, next is the US Treasury rates. So the US Treasury rates are the rates that the government pays when it borrows money. So the government borrows money by issuing treasury bonds, notes, or T-bills. And investors buy these treasuries because they're considered one of the safest investments in the world. So what affects these rates? Mainly supply and demand. If there's lots of people that want to buy the treasuries, the rates go down. If fewer people want to buy them, the rates go up. Inflation expectations also matter. If investors think that inflation is going to be high, they'll demand higher rates on the treasuries to make up for that loss of purchasing power. So the key link is this. Treasury rates are often seen as like a risk-free benchmark, and many other interest rates, including mortgage rates, are influenced by them. Like the 10-year treasury influences a lot of borrowing rates. So the consumers, whether it's mortgage rates, which we'll talk about next, or commercial borrowers like us, we borrow money from agencies and HUD and things like that. And a lot of those are directly affected by the 10-year treasury. So mortgage rates. Now, this is the rate that consumers use when they borrow money to buy a house, and many of you probably have a mortgage, so you're directly affected by this. Those are set by the lenders, but they're closely tied to that 10-year treasury year that we talked about. So the 10-year, because most of the time mortgages are paid off in 10 years or they're refinanced or sold, so lenders tend to use that 10-year treasury as the benchmark. They'll take that 10-year treasury and then they'll add some spread to it, which is how they make money. So what affects the mortgage rates? Well, the 10-year treasury, inflation expectations, and just the overall credit market conditions. So when treasury rates rise, mortgage rates rise too, but they're not identical, if that makes sense. And again, lenders add that margin, or they add on to the treasury for their profit and their risks and costs and other things. All right, so how do these things all affect each other? Connect the dots here, if you will. So the Fed funds rate is like the foundation, and that influences the short-term borrowing across the country. The changes in the Fed rate can definitely influence investor demand for treasuries. So the Fed funds rate is like the foundation, and it definitely affects other things. Changes in the Fed funds rate definitely can affect investor demand for treasuries, and they can often, if the Fed rate goes up, then treasuries can sometimes go up because the buyers of the treasuries will demand a higher return. So, and like we said before, treasury yields, especially on the 10-year, definitely affect the mortgage rates. So here's an example, and this is what could happen. It's not always what happens, but if the Fed raises the rates to battle and fight inflation, then short-term borrowing costs rise, which could lead to an increase in treasury yields, which then would lead to an increase in mortgage rates, which makes home loans more expensive. On the other hand, if the Fed cuts rates, treasury yields may drop, And if that happens, then mortgage yields may drop, also making borrowing for a home cheaper. And that's what a lot of people right now are hoping will happen. There's a lot of consumers, home buyers and sellers that are sitting on the sidelines waiting for this very thing to happen. And so they're all watching to see, oh my gosh, what's the Fed going to do? They're going to cut rates. Well, it's pretty apparent that they're going to cut rates at this next meeting in September. Doesn't necessarily mean that the yields will go down and thus the mortgage rates will go down. It could, and a lot of times it does, but it doesn't always work that way. All right, so here's the recap. Fed funds rate is what banks pay to each other for overnight borrowing, and that's controlled by the Fed. So when the Fed makes an announcement, that's what they're talking about. Treasury rates are what the government, the US government, pays when it borrows money, and that's set by supply and demand from investors. Mortgage rates are what you and I pay when we want to buy a house, and those are strongly tied to the 10-year Treasury. But while these are all different, they're all connected in a chain. The Fed influences treasuries, treasuries influence mortgages, and together they shape our whole borrowing of money in the economy. If you found this breakdown helpful, give this video a thumbs up, subscribe to the channel. We'll have more easy to understand videos on real estate, investing, and finance coming. So if you're interested in how the interest rates affect real estate and investing, stick around. We've definitely got more videos coming your way. Thanks.